So we'll start now. Um, Thank you for taking this session on a Saturday morning, and thank you everyone for joining in the call. I'll first start with the introduction of our speaker. Mr. Harshad Borawake is the head of research at Mirae Asset AMC. He manages more than 10,000 crores across four schemes. That is Mirae Multi-Asset, Balanced Advantage, Aggressive Hybrid, and Equity Savings. He has an overall experience of more than 18 years in the asset management industry. And before joining Mirae, he has worked with Motilal Securities as Vice President Research and Capmetrics as Equity Research Analyst. He has a bachelor's in engineering and MBA in finance. Thank you, Harshit sir, for joining in the call.
Sure. Thanks, Aditya, for inviting me. Yeah. Good morning.
Yes, sir. So I'll first start with a very popular question. Multi-asset category in mutual funds is popularly gaining attention in the market. Can you explain for the audience what we mean by multi-asset?
Sure. So yeah, as the name suggests, multi-asset, it has different, multiple assets rather than, if you look at typical equity scheme. So when you say asset, basically it's either equity from the financial market point of view, equity, debt, or commodities, or arbitrage. So these are the different asset classes within investing, what we look at. So multi-asset is a part of a hybrid category funds. So if you look at in the equity markets, either you have full equity, hybrid, or debt. So different kind of funds. So within hybrid category, you have multi-asset as a category. Essentially, how different it is from other hybrid funds, if I were to just explain in a minute. So typical hybrid fund would have one equity. Second, it could may or may not have arbitrage, and third is debt. In the multi-asset, there is one more category which is added, which is commodity, which typically, from our investing point of view, essentially it can be gold, silver, or maybe other commodities. But essentially, 99% of the time, it is gold and silver. The other feature for multi-asset and more mainly filtering from our fund point of view. So the asset allocation within the fund is dynamic asset allocation, which means depending on where the market valuations are, the net equity percentage can go as low as 40%, can go as high as 70% also. Secondly, if you think from the basic asset allocation, so one is as per the SEBI rules, each asset, the asset which we have should at least have 10% weightage within that asset category, which means gold or commodity should have at least 10%, debt should have at least 10%, and depending on taxation, whether it's equity taxation or debt taxation, then there's the equity portion. Our multi-asset fund, so it's equity taxation, which means at any point in time we need to have 65% equity, which can be a combination of cash equity or arbitrage. So all put together has to be 65. Then the remaining 10 to 15 can be gold, and the rest can be debt. So that's largely a multi-asset as a category. And if you were to ask me how what basically it achieves in for a investor, for him, so I think essentially what it does, if you look at three asset classes, equity, debt, and gold. Equity, for example, as you know, history for the last 10, 20 years, be it in India or globally. So return wise, the equity will give, much better returns, but at the same time, volatility will be higher.
Right.
On the debt side, returns are lower, but the volatility is almost minimal. And gold, on the other hand, I think returns are between, equity and debt, and volatility slightly, I would say, in between these two asset classes. What multi-asset does is combines these three things. So one, it reduces volatility. Second, in terms of return, over the period you have decent returns. And thirdly, I think because, for example, when I say gold, we are adding gold here. So see why we diversify, assets, or where people say don't put your eggs in one basket. Essentially, it is to have a diversification. So here what we do is that gold has a negative correlation with equity, and we
Right.
have done the study. So it's minus 0.3 as a number. So it has a very good negative correlation. So it gives a good diversification. So that's essentially, I would say, in a nutshell, what multi-asset as a category is. If you have any more questions, we can take those here.
Absolutely. And particularly, we have seen the multi-asset funds, legacy funds, compounding at about 16 to 20% over the last 20 years. And that is at a much lower volatility. And the negative correlations, as you said, the minus 0.3 of gold with the equity definitely reduces the volatility, but in long term, it also gives good compounding for the investors. And so you manage four hybrid schemes in Mirae Asset Mutual Fund. And you said that it's a dynamic asset allocation that you do. So how do you arrive at this asset allocation? Is there any formula that you use, or
Sure,
do you
sure.
have any framework, particular framework that you have in the as a fund house?
Yeah. So yeah, we have a framework. So essentially, if you have to think as a basic human nature. So if markets were to go at a very high level, which let's say is currently the state. So at this point in time, even me as a fund manager or you as an investor, so we kind of get biased at market levels, either when they go at a very high level or if markets were to fall down at a lower level. Let's say if you go back in 2008, or if you go back to the recent COVID crisis. So there, essentially, when markets go at the extreme level, so as a investor, as a fund manager, it's kind of get difficult to take an objective call. So what we have done is we have the equity allocation in the multi-asset fund or even other funds. So it's a model-driven equity allocation. So what we have done is we have taken last 11, 12 years of daily data points. We have used three parameters essentially. We have price to book. Then we have spread of asset, earnings yield and 10-year GSEC. So we have taken all these three parameters and arrived at a composite score. So what we have done is price to book has a higher weightage of roughly 75% and the spread has roughly 25% weightage. So where the
Okay.
composite score is, so that will decide where my equity allocation should be. So for
Right.
example, if you look at right now, if you were to ask me, so when we launched the fund, the composite score was roughly so saying that equity allocation should be around 55%. But
Uh,
after that, markets kept on moving higher. So to that extent, composite score suggested that we should reduce the equity. So right now, after the last 2 months, now the model is saying that we should be around 50%. If you look at range, so we have a range of 40% to roughly 70%. Right now, when I say my model is suggesting 50%, so the remaining 15%, as I said, it's equity taxation. So you need to have 65% equity. So 65 minus 50 will be a 15% as an arbitrage position within the fund. But to answer your question, it's a model-driven kind of thing. So to that extent, it avoids human biases. If my model suggests X number, I will go to that. We have kept some flexibility of 3 to 5% with us beyond
right.
what model is saying. And primary reason for flexibility is one fine day, let's say election results or Fed gives some decision. So on those days, numbers price to book and immediately will not capture those events. So some flexibility we have kept with
Absolutely.
it. Yeah.
Right. 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 And so you talked about this arbitrage component, that you need to have a gross equity of more than 65% to be eligible for equity taxation. And since your net equity allocation, say, suggests 50%, 15% is compensated by arbitrage. The people don't understand this arbitrage component. There are arbitrage funds as well in the market. So can you explain what is equity arbitrage and how does it work?
Sure. So see, arbitrage is nothing but it's a fully hedged position. So at any point in time, when we entered into arbitrage position, so it's nothing but taking advantage of time spread. So what the stock is available at current price, and let's say 15 days down the line, 1 month down the line, at a future price. If there is a spread, so we try to capture that spread. Uh, all the arbitrage positions, 100% arbitrage positions. So they are not net long or net short. So there is a
Right.
hedging which happens at the time we enter into the position. So there is no risk on the arbitrage. Typically, if you look at the returns from the arbitrage position at a portfolio level, they largely track, I would say, money market returns or let's say overnight fund debt returns. So
Right.
typically right now when the liquidity is tighter in the market, so arbitrage positions can give return of 6.5%. Typically, I'm seeing. If the liquidity is higher in the market, then it returns can also go down to 4.5-5% also. So that's roughly the range. On an average, that's what arbitrage positions. So it's a fully hedged position. So there is no typical FNO position. That's not what it is. It's a
Right.
hedged
Right.
position which is there. Yeah.
Right. And that's what we also explain our investors that the fund, arbitrage funds in general, they are just trying to capture the risk-free rate, and it offers much better taxation to you.
Yes.
So that plays out very well. And so we often receive many questions on gold as an asset class. And particularly, we look at as an hedging asset class as it has a tendency to stagnate for long duration and then have short periods of price rise during global uncertainty. As a multi-asset fund manager, how do you look at gold as an asset class, and what would be the component in your fund uh,
Sure.
for gold?
So I think gold, as an asset class on its own, clearly serves, a lot of purposes. So one on its own, we believe that over the period, over the generations, it has proved, as a wealth creator asset.
Right,
Returns, surprisingly, if you look at last 20 years, so they have largely in and around, I would say, equity markets. But the only difference is, in the gold is that it can remain flattish for long period of time, and there could be some spurts in terms of price increase.
right,
Essentially, historically, what we have seen that whenever there are turbulences or economic uncertainties there, let's say go back to energy crisis in 1979 or dot-com bubble or global financial crisis, recently COVID. So at those kind of period when there is more uncertainty, you have gold as a asset class doing well. Uh, for us, if you think from the multi-asset fund point of view, so as I said, at any point in time, we need to have 10% minimum commodity. We can also have
right,
silver, but silver, what we have seen that it's largely an industrial metal and not necessarily store of value the way we look at gold. So silver we might add tactically, but right now, if you ask me, gold also has shown some correlation with the interest rates. So typically, when interest rates start to move down, gold as an asset class, does well. So to that extent, what we
right,
have done is what we are doing right now is instead of 10%, we are having around 11 to 12, can even go, we can go up to 14-15% also. So slightly higher than 10-11 is what the current stance is, on the gold. And then, as I
absolutely,
said, initially it has a negative correlation with equity. So that's the added
right,
advantage.
right, and it plays out very well.
Yes.
Uh, and sir, well, coming to the interest rate, and as you said that you have seen that declining interest rate, gold also does well. How do you look at the current global interest rate scenario, and how will it affect the central bank policy in India?
Sure, I think see clearly, world is quite correlated. To that extent, said RBI will take cues from what the Fed does. Also, we have to maintain some spread with US interest rates so as to our inflows, forex inflows should not get impacted. So to that extent, I think whatever Fed is doing or is trying to do, so recently, I think they are talking about three cuts this year, but clearly it will be data-driven approach. So to that extent, they will watch the inflation number, they will watch employment number, and then eventually take a decision. I think market consensus is that somewhere around in the June, July, they should take some rate action. But I think historically we have seen it's no point in timing those kind of things. So to that
Right,
extent, can it happen 3 months, 6 months? I think it's anybody guess, but directionally over the 12 to 18 months, we can say that interest rates will start moving down. I think equity as an asset class does well when interest rates are lower. Primary reason
right,
is when we invest in into any equity or any company, we value the cash flow of that company, right? And we use some discount rate, to value the cash flows, and discount rate is impacted by the interest rate. Higher the interest rate, higher the discount rate, so the value of the same cash flow reduces, and the vice versa. So to that extent, I would say the interest rates moving down will be supportive for equity markets. Not necessarily markets will move up, but it will be supportive for the equity markets. Yeah.
Right, right. And sort of the very popular question that we get on elections, how do you as a fund house see the impact of elections on markets? Is the result somewhat already factored into some extent? Does it happen? And how do you look at such an event risk? Does it really play a big role in your models, or it's something that you just account it as a risk that's not that cannot be factored in?
See, I think while I think the answer I would have multiple approach to this. So
Sure.
one is, election point of view, looking at the where markets are. At a broadly, one can say that, markets are expecting that the incumbents should, continue even in the post-election. That's largely the market thought process. That's what we believe. We can be wrong. Secondly, when we invest into equities, frankly, okay, events like interest rate change, events like election, or some global crisis, something like that. So all these are important to note. But eventually, see, point is we invest in the companies. So to that extent,
Right.
our more focus is on understanding the company, understanding the drivers of the earnings of that company, trying to look at how the management is, how the capital allocation is, how the balance sheet is. So 99% of our time goes on this. So this is the last 1% when you think okay, what's happening globally, what's happening on the interest rate. So it's important to note. But does it impact my whether I buy this company or not? I think essentially answer I would say 99% no. As long as there is a value in a company, I will try to invest. Basically, I will try to see over the cycles for the last 10, 15 years, eventually how the company has done across the cycles, how the capital allocation, how the earnings growth has been across the cycles. So that is what I think my focus would be. But yes, markets do get jittery by those kind of events. I would say that if you think from the investing in India point of view, next 5, 7, 10 years, I mean GDP growth could be upwards of 6, 7, 8%. So it's a beautiful economy, to invest into. So to that extent, all these events look at it as an opportunity rather than risk. That's our approach is generally, when these events occur.
Right. Surely. And sir, we have seen the markets rallying up very rapidly in the last 1 year. Large caps have gone up by more than 20%. Mid and small caps have gone up by almost 60 odd percent. And there was indication by SEBI as well that there is certain froth building up in this space. So do you believe that hybrid funds at this point in time and all what we have seen is that money flows based on the market performance. So if small caps have given good returns, then money would kind of flows there because people look at past returns. But if I look at the market performance and the valuations, does hybrid funds give better risk return trade-off at this moment for the near term?
So I would say, hybrid funds are funds for all season. Having said that, even at the current market juncture, when people are talking markets at all-time high, just on the all-time high, I believe that it's a flawed concept given that GDP is going to increase every year. So to that
Sure.
extent, every year there will be all-time highs. But obviously, in the short term, as you said, the returns of mid and small, much better. So slightly ahead of earnings growth, I would say, would have happened in the mid and small as a category. I think hybrid funds more so, with dynamic asset allocation makes a lot of sense. So, for example, as you said, election as an event, right? So in and around election, if markets were to get some nervous and go down, so to that extent, we as a fund manager in the hybrid funds can take advantage of those events. We can add more equity, or eventually, if markets continue to move up, then we can reduce the equity. So from the investor point of view, I think it's the best product I would say to look at, and there is no he doesn't have to do asset allocation on his own, not try to really time the markets. So to that extent, that is taken care by this hybrid fund. So yes, I think at the current juncture, it makes a lot of sense. I think one example which between question people ask, should I go through SIP or lump sum? So I think in pure equity funds, I might say, okay, you can do 3 months, 6 months SIP. But in hybrid, I think I can say you can go through lump sum, if somebody wants to invest.
Right, absolutely. And sir, we as a wealth manager also, we are constantly thinking about asset allocation,
Sure.
and it becomes a very personalized thing for each investor, each individual. So you also look at asset allocation across all your hybrid schemes. How do you look at asset allocation at a personal level? So that is one thing that is that becomes very important for us as a wealth manager.
Sure, I think frankly, not much expert in this, but since you asked at a personal level, I think see the point is one needs to take care of basic things like for example, whether insurance is in place or not, whether emergency funds are in place or not. Depends on your age, what your current priorities for the next 5 to 7 years are. So to that extent, one needs to allocate. But eventual, I think the money which goes to the equity funds should be the risk money. You should let it sit there and earn, and the eventual wealth creation will happen only if you let it sit there for 5 to 7 years. If you have to ask
Right.
me, I want to invest for next 2 3 years, I would say don't come to the equity as asset class. You go somewhere else. So to that extent, I think I think 80 90% of my wealth is into the equity markets. Whatever is
Right.
in the debt side is either through PF or because so we also have to invest 20% of our earnings into our own fund. So that is what goes to the debt. But otherwise, personally, it's more equity. That's what it is.
Understood, sir. Sir. Thank you so much, sir, for beautifully answering all our questions
Sure.
and helping our audience to understand the basics of hybrid funds, particularly arbitrage. How does it work out? Your views on gold, interest rates. Thank you so much for joining in today, and we look forward to do many more such sessions with you and your team.
Sure. Thanks, Aditya.
Thank
Take
you
care,
so much.
everybody. Thank you.
Thank you, and thank you everyone for tuning in today. Thank you.